Hello and welcome to the Political Risk Podcast, where geopolitics and insurance meet. This is a special episode produced in association with Liberty Specialty Markets. I'm your host, David Benyon, and I'm joined by William Lim, Head of Political Risk Solutions at Liberty Specialty Markets. Will and I will be discussing opportunities and innovation in political risk insurance. And our jumping off point is a recent report released by the United Nations Conference on Trade and Development, UNCTAD. It's titled De-risking Investment for Sustainable Development Goals, and subheaded The Role of Political Risk Insurance. I'll include a link for the report in the blurb. The paper showcases the crucial place held by political risk insurance to help the UN to meet its Sustainable Development Goals, and the potential for PRI in closing an investment gap that stops many projects from getting off the ground, if only more awareness can be achieved about the political risk insurance product. We move on to discuss LSM's political risk insurance portfolio as a leading carrier within this business, as well as Will's personal career journey, from a psychology background and interest in human behaviours to joining LSM and specialising in political risk insurance. We conclude with a discussion about growth opportunities, innovation and trends within the PRI space, whether that's public-private mechanisms, consortia, developing portfolio-level solutions for large clients, or finding ways to demonstrate additional value to boost the product's appeal to new buyers, and in so doing, meet some of the potential that the UN report talks about. So let's get into it. Enjoy the conversation. Will, welcome to the pod.
Thank you. Thanks for having me.
The two of us started talking about doing this, and here we are. So it's nice to bring that to fruition.
Absolutely.
Great. So this is one of those episodes where it's really based around a particular report that has come out. And in this case, it's the United Nations Conference on Trade and Development. And it's specifically subtitled The Role of Political Risk Insurance. Now, that's quite notable in itself that you've got a UN body putting out a report focused on the role of political risk insurance. It's a great compliment to the industry. I think whether or not enough people know about this product line is an open question, but it certainly suggests the importance of political risk insurance that it plays.
Yeah, absolutely. I mean, I would say this is like one of my passions, I guess. I mean, I think there's obviously a huge opportunity and we'll talk a bit more about that. But I think entities like UNCTAD giving a bit more visibility to the product and the market is really what's needed at the moment, particularly given what's going on in the world. So I think it's something that a lot of investors aren't aware of. And I think the more that we can do to increase that visibility, the better.
Let's start with the report. What's it about and why do you think it's significant for the political risk insurance sector right now?
Yeah, so I guess for those that aren't familiar with UNCTAD, so UNCTAD is the United Nations Conference on Trade and Development, and it's an intergovernmental agency that was formed by the UN, and its primary mandate is to represent the interests of developing nations in the context of world trade. They've been around since 1964, and all recognized states in the world, all 195 of them are members of the organization. So just in terms of the report, what's it about? In my opinion, it's a really excellent piece of research, which the market's been calling out for, really. And what it does is it talks obviously about what's going on within this space, but it really talks to the key point, which is how the PRI product can catalyze more investment into sustainable development goals. And I think the context here is quite important. So developing nations have a significant funding gap when it comes to sustainable development. And one of the key factors that inhibits that investment and foreign direct investment into developing nations is political risk and perceived political risk. So I think what you can sort of glean from that is there's an opportunity for the political risk product to sort of help with catalyzing more investment into that development gap, which is so significant. And the reason those development goals are really important is because they're designed to improve prosperity for everyone in the world, both today and also into the future. The political risk market at the moment doesn't deploy anywhere near the amount of capacity to address that funding gap. So there's a huge addressable market and opportunity there. So the report talks a bit about that particular piece, but it also talks about things like market trends and makes some really important recommendations about how to improve the awareness of the product, how to increase its effectiveness, for example. And that's things like creating more bespoke solutions, being more effective with how the public and private market work together and things like that. So just in terms of the significance piece, as I said, political risk is one of the key factors that inhibits foreign direct investment. And this survey, as well as lots of other surveys, really talk to that point. So there's a survey, for example, by the OECD, where 80% of the investors who responded said that political risk was the key factor that inhibits a lot of their foreign direct investment. So when you think about the PRI product, which is designed to mitigate cross-border investments against defined political risks like expropriation, war risks, contractual risks, and currency risks, there's clearly a relevance of the product to investors and lenders. I mean, unfortunately, from our experience, and also as the report suggests, the awareness of the product is very, very low. So anything that can be done to increase the visibility of the product is really, really important from our perspective. And I think when you look at what's going on in the world in terms of the uncertainty and the heightened risk when it comes to economic and political risk, driven by factors like climate and demographic changes, wars, technological shifts, I think all of those factors combined make it a really, really challenging environment for our clients to operate in. And then when you combine that with this really important drive towards meeting some of those sustainable development goals, you can clearly see how there's this opportunity where the PRI product can be used to give clients more certainty at a time when they really need it. And the risk environment is not going to get easier. So that visibility at the same time as hopefully addressing some of those needs around sustainable development goals is why it's really important at the moment.
And despite that, so despite the need being quite clearly there, and you mentioned that OECD report as well, saying that lack of political risk insurance is an inhibitor for a lot of, well, I guess, reaching those sustainable development goals. Why do you think awareness remains so limited beyond specialist circles like where we're sat today in the City of London underwriting this business?
Yeah, that's a good point. So the report suggests that the lack of awareness is the main factor which is inhibiting the expansion of the market. I think in this context, it's worthwhile just breaking down the different types of providers of political risk. And as the report states, there are three types of providers. So you have your public bilaterals, which are export credit agencies, export guarantee providers. You have your multilateral public providers, and then you have your private providers like Liberty. When we go to conferences, a lot of clients have heard of the big multilateral providers, particularly MIGA, who are the World Bank's guarantee provider, political risk guarantee provider. They may have heard about, the USDFC, who are the US government's political risk guarantee provider, and they may have heard about their domestic export credit agency, but a lot of the time they haven't heard about the private market. So there's definitely a difference in awareness between the public and the private providers from our experience.
I mean, even the DFC, they use the private market.
Yeah, exactly. So there's still a relationship between the public and private market, mainly through traditional reinsurance structures. But obviously the clients who are buying the political risk from the likes of DFC and the likes of MIGA don't have awareness of what might be going on in terms of the reinsurance agreements that sit behind those relationships. And there's different reasons why clients have more awareness of those particular providers. I mean, one of the factors is because the public providers are government owned, they inherently have, benefits that are attractive to buyers of the product. And that's particularly useful from a political risk perspective, because if you think about it, if you're an investor and you're buying political risk from a government entity or an intergovernmental entity, when there are challenges with your investment, that guarantee provider can go and have a government to government level discussion to try and resolve some of the issues. So if there's a contractual issue where the host government of an investment is reneging on their responsibilities, that guarantee provider can go in and say, look, we are guaranteeing this risk. You aren't meeting your contractual obligations. You need to do something to remedy this issue. So clients are naturally probably attracted to them for those reasons versus the private market. But at the same time, the other thing I think that drives more awareness of those entities is they tend to transact with guarantee buyers or political risk buyers on a direct basis, whereas the private market is mostly intermediated, like most specialty insurance and reinsurance classes would be. So because they directly interact with clients, it means that they have to spend more on advocating for themselves publicly. They're a lot more visible at conferences. they spend a lot more time and money on marketing. So I think that's one of the other reasons why they are probably more prominent, I guess, than the private marketers. I think the other thing just to probably raise as well is, as I alluded to earlier, there's less awareness of the private market. Mm-hmm. And as the report suggests, I think it's the private PRI providers are about 15 to 20% of the PRI guarantee issuance. So it's quite a small proportion of the overall PRI market. And there's various reasons for that, which I think are probably useful to raise in this context. So the PRI product within the context of the private credit and political risk market has been underwritten since pretty much the inception of our market, so many decades. But in recent years, what's really driven the growth is the credit insurance product. And the reason for that is primarily because certain buyers of the credit insurance product get capital relief when they buy comprehensive non-payment credit insurance. So they derive an economic benefit up front from buying the product, regardless of whether they actually have a credit default on the loan that they're insuring. Whereas the political risk product is a named perils product, and for the most part, buyers will not get any form of capital relief up front. So there's a tangible benefit that clients get from buying credit insurance versus political risk insurance. I think the other thing to bear in mind is the political risk placement and the marketing process can be quite speculative at times. It takes a lot of work to generate the business. The limits that are bought are generally smaller on a per client basis when you aggregate the sort of portfolio of limit that a buyer would make. And as I said, they're also very, very technical placements. So they're quite time consuming for brokers to both develop that business, but also place it. And I think the technical point is quite important to delve into because the political risk underwriting from both a risk and a product perspective are very technical. They're quite time consuming. And it's really important that the brokers are trained in the right way and have the right experience to make sure that they reflect what the client needs in the coverage, but also reflect what's agreed between the client and the underwriter. So that structuring of the risk is very time consuming. And I think because of this, and so I guess quite understandably so, this technical time consuming element of PRI combined with the fact that the non-payment business, I would argue, is more efficient from a time perspective for brokers. It means that brokers are investing more of their time in developing that business.
And the time-consuming part of things, I'd say probably because this is business that isn't simply renewed like some of the lines of business, right? So therefore you're not just renewing an old policy.
Not necessarily. So the business tends to be quite sticky. There are different types of programs that we insure. So, we can insure anything from a portfolio of manufacturing facilities, and usually that would be on a multi-country basis. And what tends to happen with that is you would bind a 3-year policy, and then the policy gets cancelled and rewritten every year. So a lot of the underwriting is done at the initial phase, and then you re-underwrite it annually. So it's quite similar to a renewal. That's kind of, I guess, one part of what we do. When it comes to the infrastructure and energy projects, often we will be required to issue policies which match the tenor of the loans or the tenor of the investment. So it could be a 10 to 15-year policy, for example. And in that instance, you wouldn't end up renewing it. But there's obviously a chance that if you write only a 5-year policy on that sort of project, you would still need to cancel and rewrite it or renew it at some point.
So the report talks about sustainable development goals and the investment gap in developing countries.
So I think it's probably worth just touching on what the sustainable development goals are.
Yeah.
They were agreed by the UN in 2015 as part of its 2030 agenda around sustainable development. And the idea behind them was to create a blueprint to promote and hopefully achieve shared prosperity for everyone in the world from a human perspective, but also from a planet perspective, both now and into the future. So there were 17 goals that were agreed, and they range right the way from alleviating poverty through to ensuring access to clean and affordable energy, promoting more infrastructure, as well as things like better access to clean water and sanitation. So that was the idea behind those sustainable development goals. And as I mentioned earlier, as the report alludes to, there's an estimated 4 trillion investment gap annually for sustainable development in developing countries. And I think what's clear is that the public sector alone can't achieve that funding gap. So firstly, there needs to be more participation of the private market, but also collaboration between the public and the private market in order to achieve those. So the way I see political risk fitting into this is one of the main challenges in developing countries is often political risk, and the political risk product can therefore be used to get investors, so both equity investors and lenders, comfortable investing into key strategic projects in these countries, and therefore hopefully supporting a more successful and timely achievement of those sustainable development goals.
When you're trying to bring in new talent to this sector and you talk about insurance having, a social role, and when you get Gen Z involved, the obvious things would be to talk about climate, for example. You've got something like political risk as a product that unlocks investment to allow the SDGs to come to fruition, or something nearer that anyway. It's just essential.
I suppose the challenge is that, we are commercially driven entities, and there's always that, different entities have different mandates. And I still think in the context of like big infrastructure projects and big energy projects, there's a place for insurers to hit their commercial return hurdles, but also support things that are really meaningful and have an impact.
Well, that's a nice segue to talk about Liberty Specialty Markets' own book of business and your role at LSM, and how long you've been working on this political risk solutions book.
Happy to. I guess my background is, before I joined the market, I'm a bit of a failed psychologist.
We got to have our own journey.
Exactly. Yeah. So I studied my undergrad degree in psychology down in the sunny region of Wales in Cardiff. I absolutely loved my degree, and I had the option to stay on and do a master's and a PhD and fully qualified, but that's just not a route I decided to go down. So I took a different path. But yeah, my degree was fascinating. Like, I had such a diverse experience there, and a psychology degree is fascinating. It was really varied in terms of a lot of quantitative work, lots of statistics. That's something I still really enjoy, but also some really interesting kind of qualitative work as well. And you get to study some of the really famous experiments day to day, like things like the Milgram experiment.
I remember doing that at A-level, yeah.
Yeah, people electrocuting each other. And, hearing about people like Phineas Gage and, all sorts of weird and wonderful things, and really enjoyed that. But I suppose if you would continue in that field, most of the jobs realistically are clinical roles. And I just didn't see myself doing that. I think the thing that I was really interested in at university was around actually psychology of decision making, and more specifically how humans make decisions. So I did a lot around, decision making around risk, how humans have biases and how heuristics affect your decision making, looking at probabilities, doing a lot of experiments around that. And when I was thinking about how to apply that, actually in the context of a risk taking kind of career pathway like underwriting, that's kind of how I started to think about going down that route. So I made the decision to come to London on the basis of thinking that I'd quite like underwriting, and joined Liberty 12 years ago. So I joined Liberty a couple of years after Peter Sprent took over the credit and political risk book from Matthew Moore. So Peter joined 2 years before I did, and then Hugh Owen, who's now the global head, joined I think a year before I did. And Peter and Hugh have been hugely successful in terms of growing us from what we were, which was syndicate-only platform with 8 people. We only had 2 offices at that time. And then in the subsequent sort of 13 to 14 years since those guys started sort of building out the team, we've grown into a market-leading dual platform franchise with expertise in credit and political risk. We've got around 65 people in the team globally, and we've got people all over the world. So we've got underwriters in London, Paris, The Hague, Singapore, New York, Washington, DC, and LA.
So it's a pretty globally diversified book based on that, I imagine.
Exactly. So I spent the first 7 or 8 years doing generalist underwriting. I was really fortunate to underwrite credit and political risk for all the types of clients that we cover. And I really enjoyed that. But I found the thing that I was sort of really enjoyed during that time was the political risk element and the rigor that involves. And it's quite technical. And I enjoy that element of political risk underwriting. And at that time, when I started to focus on it a bit more, it was a part of our book that we were quite underweight in. And Peter and Hugh had a lot of experience in previous companies underwriting political risk. And we sort of sat down and I guess we had the discussion around whether we think it's an opportunity. And, I was strongly supportive of us trying to build that part of the book out in terms of just the sort of portfolio diversification that it brings, but also, diversification in clients, diversification in risk, and so on. And so we agreed at that point, let's try and see if we can build this out and do it in a sort of globally consistent way. And I moved into the political risk practice leader role at that point. That was about 4 years ago. And then a couple of years ago, Peter moved on and Hugh took over as the global head. And when he took over, just in order to position the team for the next stage of its development, he restructured. So we still have a global team structure, but we also have now global product pillars. So we have one for short-term credit, one for all other credit, so any credit business over 18 months, and one for political risk business, which is your traditional political risk and also the pre and post business. So as part of that restructuring, I took on the head of political risk solutions. As well as that responsibility, I'm also an underwriting manager in London. Just in terms of what that head of political risk role really means. So we think of it, it's a bit like a product CEO role. So sometimes we also say it's a bit like Lloyd's role in the market in terms of promoting and protecting the business. So there's quite a broad set of responsibilities. So it's things like setting strategy, aligning appetite globally, chairing risk forums, working with our regional teams to execute on strategy, reviewing wordings. I spend a lot of time reading contracts, which I quite enjoy. But it's one of those things that's not necessarily for everyone. And then, business and product development is also a big piece of it as well. So that's the head of political risk role. And then as an underwriting manager, I sit in a management team of 3 people in London. So the London head, Sam Wild, and the other underwriting manager is Catherine Tuckett. And we're sort of responsible for the day-to-day running of the London team. And that part of the business, which underwrites all different products, probably about 60 to 70% of our global income.
This is a line of business that is globally relevant. And the report, we've been talking about the UNCTAD report, get into that. So geographically, where are there some parts of the world where you're writing more business?
I guess
I should say where the projects are, maybe.
So we've got a pretty diversified portfolio. And I think it would be useful to talk about what the overall political risk portfolio looks like, but also the subset of that portfolio, which is probably relevant to this report, which is the core infrastructure and energy assets. So when we look at our overall political risk portfolio, we have just over 20% in Asia. And a lot of that is exposure to manufacturing sites in places like Indonesia and Malaysia and so on. And then we have around 20% in Africa, 20% in LATAM, and then the residual is in other regions. But when you look at the subset of the political risk portfolio, which is relevant to this report, which is the infrastructure and energy assets, it's a bit more concentrated from a regional perspective. So about 40% in Africa, 30% in LATAM, 10% in Southeast Asia. So, it's slightly different at the PRI portfolio level versus that subsector level. But I think what's probably really important to emphasize is even though, that sounds relatively concentrated in terms of the proportion of exposure in Africa, for example, it's still an incredibly diversified book. So we never have more than 10% of exposure in any given country. For the vast majority of countries, it's probably less than 5%. And if you take Africa, for example, for the energy and infrastructure portfolio, we've got exposure to 32 different projects in 20 different countries. And that's one of the keys, I think, from a strategic perspective is diversification when it comes to this business.
I hate to try and generalize too much, but maybe for some listeners who aren't familiar with how a PRA placement typically works, can you walk us through a typical project, if that is possible from your perspective, to think about who the main stakeholders might be and what you're actually insuring?
A typical project would be something like an energy project. It could be conventional power, so like a gas combined cycle turbine project or a renewable project. We have exposures to the solar, wind, hydro, geothermal. So it would be that sort of project, and we would be covering either the equity investor into that project or the lender into that project. And in terms of what we're indemnifying them for, when it comes to equity PRI, for the majority of the perils, what we're covering is a loss of net investment value or loss in net book value due to a political risk event. When it comes to a debt provider or lender, we're covering a default on a scheduled payment because of a political risk event. So if the project company gets expropriated and then they default on a payment, we would indemnify for that. That's quite a simplistic way to describe how the product's structured, because for different perils, so for example, political violence, if it was an equity investment, we would cover not the loss of net investment value, we would cover the physical damage loss.
Yeah, so it suddenly becomes a property.
Exactly. So there's an overlap with that sort of product. For our business, as I said earlier, most of it's intermediated. So what will usually happen is we'll be approached at an early stage of a project to provide some indicative high-level terms. And if the client's interested in those, then we usually get access to a more comprehensive data room, which will include things like the client's due diligence, external due diligence from external legal, things like environmental and social impact assessments, as well as all the project documentation, because often we'll be covering arbitration or default linked to project contracts. So we have to look at all of that. So in parallel with that due diligence, we're also usually, as a lead market, we'll be drafting the policy wording with the broker alongside that. That can be relatively time consuming, although the brokers do have their own template wordings, which we base each project on. We often have to adjust various parts to reflect the risk. I would say the average sort of timeline between the initial inquiry and binding a policy is probably somewhere between 2 and 6 months. It can be longer because often we're just tracking the execution of the project. And as you know, with infrastructure projects, particularly in developing countries, there are roadblocks along the way and they can take time and they can have delays. So sometimes it can be longer than that. Equally, it can be shorter. So we've worked on policies that we've received the inquiry and bound the policy within a week. Our London team had to do that last year.
Is there evidence for increased demand, at least as far as you can see anyway, in the market for PRI? In your own experience and the market more broadly, what do you think is driving that growth?
In short, and as I think you won't be surprised to hear, yes. So we track our submission data pretty closely. And what we've seen in the last couple of years is you had quite a material uptick from 2022 into 2023. I think that was most obviously driven by the Russian invasion of Ukraine, some of the geopolitical fallout of that. Then going into 2024, that level of demand remained, but didn't grow. And then looking at the 2025 year-to-date data, there's been another jump this year. So it's about 30% up on the year-to-date position versus last year. So there's been a material jump from 2024 into 2025. I think that's probably driven by what's going on in the Middle East, as well as I think what's going on from a US government policy perspective in terms of tariffs and just the broader, I guess, more protectionist policies that's pushing across the world and the impact that that's having on foreign direct investment and how comfortable investors are in certain jurisdictions. So when you look at in aggregate, I think our inquiry count has doubled over the course of 3 years, and this year will be a record year.
So going back to that report from UNCTAD, it has recommendations in there, and those include tailoring PRI offerings to emerging risks. Are there some good examples of this already that you can share of bespoke solutions for clients, either that you're working on or already exist?
Definitely. So I can give you a flavor of the things we're working on. So we've been looking at some new products for both pre-operational phases of projects and also the operational phase of projects, mainly on a single project basis. We've also been looking at some portfolio solutions, and then there's some value add product developments that we've been working on. So I can talk through those 4 things. When it comes to the pre-operational piece, what we've been looking at with that is how we can design a product which helps projects reach financial close. And there are different ways of doing that. And hopefully in the future, we can give a bit more information on what that will look like. But I think using the PRI product to try and smooth issues at an early stage of a project and ensure that the capital flows into that project on an ongoing basis and it can reach financial close is really important. And, you can clearly see potential catalytic role that can have. But, to give you an idea, we're looking at things like how do you use dispute resolution processes within the policy to ensure the ongoing success of the project. So that's quite an interesting opportunity, we think. When it comes to operational project coverage, a lot of that is focused around looking at how we can improve the bankability of projects. And we're working on some opportunities directly with some public agencies or public providers, some opportunities indirectly with public providers. But that's looking at specifically energy projects and how purchase agreements can be made to be more bankable through some of the provisions that we can provide under our policies. So that gives you an idea of some of the things we're doing on the pre-operational and operational side of projects. The portfolio piece is quite interesting. So we're working with some infrastructure and energy funds, and we're looking at how we can provide some portfolio-based solutions to those entities. And I think what they find quite interesting about this is when a fund gets created, obviously they go through a fundraising process and they get limited partners, LPs, to invest into the fund. What happens, or one of the challenges that we're hearing from these fund clients, is that certain LPs will not be comfortable investing into a fund if they're going to be focused on investments in challenging jurisdictions. So because of the political risk. So the idea and what makes it attractive to us is the fund may raise a certain amount of money without political risk insurance, but then they may sort of be able to uplift that by using PRI for certain LPs into that fund. So when the fund then invests into projects, that fund will have quite potentially a significant amount of uncovered investment into a project, as well as some that might benefit from political risk. So you get a better alignment of interest, because our typical policies will be 100% indemnity, pure risk transfer products. But this sort of fund level PRI is quite interesting because you can get more alignment of interest with the investor ultimately, and also, hopefully less negative selection, because the idea would be every single investment that fund makes would benefit, or a proportion of that would benefit from political risk insurance. So that's quite an interesting development. And it's also very efficient for the fund because we negotiate the terms of it up front. And the challenge is creating like underwriting parameters around what qualifies as an insurable risk, making sure you can price dynamically, making sure you have the ability potentially to say, no, we're not insuring this investment for whatever reason it is. So that's something that could be quite transformatory for some of those clients. And you can clearly see there how the PRI could crowd in capital into important infrastructure and energy projects. And then the final piece is just around the kind of value add point. And particularly in an inflationary environment, the feedback that we get is that political risk is often the discretionary buy for a lot of clients. And what they really need to ensure is they get the maximum amount of value from the product as possible. The report picks up on this because I think there is some negative perception out there ultimately around the value of the PRI product and the cost. So what we're looking at is how we can build in some value add services that aren't necessarily around coverage, but they're more linked to sort of advisory pieces. And that's something that I think hopefully we'll be able to talk a bit more about in the future, but just ensuring that clients actually see some value regardless of whether they have a loss under the policy or not. So that's quite an interesting area that we're trying to develop a bit more.
So, Will, how are blended finance mechanisms, public-private structures, changing the way that PRI is being used, or can be used, for instance, for some of the infrastructure or energy projects that you've been mentioning?
The relationship between the public and the private market, I would say, is pretty symbiotic. And we're mainly interacting through traditional, as I said, traditional reinsurance structures. But I think ultimately more could be done actually to increase that level of collaboration. And I think the key is working out, who's the appropriate entity to take which level of risk. And private insurers have a different mandate to a public multilateral, to a public bilateral, to a philanthropic fund, for example. And I think what we need to do to get scale is make sure the right entity is sitting in the right position from a risk-bearing capital perspective. So I think trying to figure that out at scale is one of the main challenges, and making sure that we're not competing over the same business, for example. Yeah, maybe there's more that we could do to make sure we're complementing each other more. I mean, I'll give you a good example. So if you take a conventional power project in a low-income country, the way it will usually be developed is you'll have a private investor who will be developing the project, and they'll sell the power to the state utility in that country. That state utility might not be creditworthy on a standalone basis. So in order to make the project bankable, you have to get some form of guarantee or risk mitigation on the credit risk. And the way that's usually done is a government guarantee, but governments are finding it very difficult to issue those guarantees because they have to recognize those as liabilities on their balance sheet, which means that it can affect their leverage and their debt sustainability ultimately, and their credit rating, which affects the cost at which they can borrow money, but also their ability at all to borrow money. So governments are becoming increasingly stretched in that regard. So we need to find different solutions to that mitigation point around those offtake agreements. So there are a few structures in the public market which are designed to mitigate that. So things like the World Bank's partial risk guarantee or a TD's reserve support liquidity facility, but those are being done on a relatively small scale from what we can see. So we want to see how we can bring in the private market to scale those up. You know, can we bring more first loss capital, which doesn't necessarily have a minimum return requirement? And then if you build that up into a product which has the right people holding the right levels of risk, then you can get more scale. So yeah, I think there's a lot more to be done. We are seeing things out there. There are different entities that have some first loss capital that they can call on, which sits outside their standard business, but that's not being done at the scale that we probably need it to be to address some of these challenges around sustainable development goals.
There is plenty of capacity, I would say, in credit and political risk, plenty of market entrants in recent months. However, I mean, clearly this UN report, for example, wants to raise awareness about this product. So does the current lead and follow market have the capacity to meet that demand?
That's a good question. So the market reports that get released every year suggest there's, if you aggregate the maximum line size of all the direct players in the credit political risk market that have political risk capabilities, the aggregate capacity is about 3 billion. The reality is we never work on placements that are 3 billion. So in theory, on an individual risk basis, we should have capacity. In the market, you know, the average placement's probably somewhere between 50 and 200 million. A really big placement will be somewhere between 800 and billion. That's all done on a syndicated basis or co-insurance basis. So, you know, I think on an individual risk basis, there should be capacity. What we are seeing is, because it's a very technical underwriting class, and this alignment of interest piece combined with the time that it takes to get comfortable with risk, we're seeing the smaller players with maybe less resource stepping back a bit. You know, but at the same time, we are seeing some carriers wanting to step into this area a bit more because they've taken on a lot of exposure to credit risk. And you know, since the global financial crisis, it's been a very benign period from a credit risk perspective. And although a lot of that market, the risks are very well rated, they're very well structured, often benefit from security, they are exposed ultimately to correlated credit risk in a way that the political risk product isn't. So, you know, we think it's very prudent ultimately for carriers to have political risk exposure in their book when it comes to optimizing their portfolio from a risk, but also from an income perspective and building resilient income from a different set of clients. So, you know, we would definitely be supportive of that approach. And at Liberty, political risk is an absolutely integral part of what we do, and it will be going forward. And I think that diversification piece is essential. So I think if the demand continues to grow and we can bring more top quality clients to the market, I think it will be a growing part of the business. And I think the other point to sort of flag is that the credit business is also inherently exposed to regulatory risks because this capital relief point, and the regulator could change its approach on whether the product qualifies for capital relief relatively easily in theory. I think the reality is that wouldn't happen, but there is that risk out there. So I think it's also quite a defensive play from a carrier perspective to make sure you have that diversification in income, just in case there is some sort of regulatory change which affects the amount of credit business you can write. I think on the lead follow point, our market sort of informally does this, in our opinion, and we think there's definitely an opportunity to formalize the lead follow model more. And we're looking at a few different options in this regard, and we're definitely open to speaking to other carriers if they want to partner with us in that context.
Do you just mean consortia?
Yeah, things like that. Yeah. And I think the real sort of motivation from our perspective is we can deliver the best products to clients probably in that way, because it's quite a technical class. As soon as you have lots and lots and lots of carriers all trying to negotiate, let's say, a complex wording, you just bring in so much more execution risk around a placement. And as the report sort of suggests as a recommendation, we need to improve that efficiency of placement. So anything that can help clients access a more efficient placing process is great, and that obviously helps brokers, I think. And then from our perspective, if we can get more efficiency in the underwriting process, it allows us to free up more time and hopefully to invest more in things like new products and just providing those sort of best-in-class solutions to clients and brokers. So yeah, we definitely think that's probably a direction of travel for our market. So we'll see how it goes.
That's all for now for this special episode in association with Liberty Specialty Markets. I've been your host, David Benyon, and I'd like to thank my wonderful guest, Will Lim, Head of Political Risk Solutions at LSM. Production was by Peter McGill, and Lawrence Durkin made the music.